Launching a startup is an exciting adventure, but it takes resources to turn your vision into reality. This is where startup capital comes in, the fuel that propels your business from idea to a thriving entity. But with so many funding options available, navigating the financial landscape can feel overwhelming. Fear not, aspiring entrepreneur. Because in this video, I'll break down the most common types of capital for your startup along with actionable steps to secure them. I'll also mention how you can possibly choose the right capital mix for your startup. If you have not already, I really encourage you to subscribe to this channel and hit the notification bell to always get notified whenever we post a new video. Also remember to like this video. Before diving into specifics, let's establish two fundamental categories of startup capital: debt and equity. Debt financing is like borrowing money. You receive a loan from a bank or lender, which you repay with interest over a set period. It doesn't dilute your ownership, that is, the percentage of the company you control. Equity financing involves giving up a piece of your company in exchange for funding. Investors become shareholders, meaning they own a stake in your business and potentially share in future profits. Outside debt and equity financing, a great way to get started with financing is to build from your own resources. The most common, and often overlooked, source of capital is your own resourcefulness, bootstrapping. This involves using your savings, credit cards, or income from a side hustle to fund your startup. Although this may limit your initial funding capacity, it allows you to maintain complete control over your business. Here are some actionable steps for bootstrapping, that is, building from your own resources. 1. Plan meticulously. Create a detailed budget outlining your startup costs and potential revenue streams. 2. Embrace frugality. Find creative ways to save on expenses, like utilizing free online tools and shared workspaces. And 3. Explore side hustles. Consider freelance work or a part-time job to generate additional income. Now, let's talk about debt financing. If you're yet to subscribe to this channel, we really encourage you to subscribe and hit the bell icon to be sure you'll always get notified whenever we release a new video. This will also encourage us to produce more amazing contents like this. Alright. Debt financing offers a way to acquire capital without giving up equity. Here are some common debt options. 1. Small business loans. Banks and credit unions offer loans specifically designed for startups. These typically require a solid business plan and good credit score. 2. Lines of credit. Similar to a credit card, a line of credit allows you to access funds as needed up to a pre-approved limit. It's ideal for ongoing operational expenses. And 3. Invoice factoring. If you sell products on credit terms, invoice factoring allows you to sell your unpaid invoices to a factoring company for immediate cash, minus a fee. Here are 3 actionable steps for securing debt financing. 1. Build a strong credit score. A good credit history increases your chances of loan approval and secures better interest rates. 2. Develop a comprehensive business plan. This document demonstrates your business's viability and convinces lenders to invest in you. 3. Shop around for the best rates. Compare loan options from various banks and credit unions to secure the most favorable terms. Talking about equity financing, that is, sharing ownership for investment. Equity financing involves selling a portion of your company's ownership to investors in exchange for capital. Here are some key players. 1. Angel investors. Wealthy individuals who invest in promising early-stage startups, often providing valuable mentorship in addition to funding. 2. Venture capitalists. Firms specializing in high-growth startups. They typically invest larger sums but expect significant ownership and a high return on their investment. For more information about venture capitalists and how they work, click on the video card above and watch after this video. It's just 7 minutes. And if you need a video that demystifies the term private equity, you can click on the video card above. It's just a 6-minute video. Now, the third key player in equity financing is crowdfunding platforms. Online platforms like Kickstarter and GoFundMe allow you to raise capital from a large pool of individual investors. And here are 3 actionable steps for securing equity financing. 1. Refine your pitch. Develop a compelling presentation that clearly outlines your business idea, market opportunity, and potential for growth. 2. Network with investors. Attend industry events, connect with angel investors online, and reach out to venture capitalists whose investment focus aligns with your business. 3. Build a solid team. Surround yourself with talented individuals who complement your skills and strengthen your business proposition. So, how do you choose the right capital mix? The ideal capital mix for your startup depends on various factors like your stage of development, funding requirements, and risk tolerance. Early-stage startups often rely on bootstrapping and angel investments, while established businesses might consider venture capital or debt financing for expansion. Securing capital is a crucial step in your startup journey. By understanding the different types of funding available and taking the necessary steps to attract investors or secure loans, you can fuel your business and turn your entrepreneurial dreams into reality. Remember, securing capital is just the beginning. Be prepared to demonstrate responsible financial management and a commitment to building a successful venture. With the right resources and a strategic approach, you can navigate the exciting world of startup finance and propel your business towards sustained growth. Please, remember to subscribe to this channel and hit the notification bell to always get notified whenever we post a new video. Also remember to like this video. And to assist you in your financial journey, consider watching any of the videos on your screen right now.